So last week we saw the RBA move rates higher for the first time in over a decade, and one of the last few developed market central banks to essentially do so. As Michael Knox called out last week, look, what changed? It was really the inflation outlook. So the RBA only 3 months ago had expected inflation to end the year up at 2.75, so within its target range. But as of the last inflation print, they had revised that significantly higher. So expecting now core inflation to end the year up at 4.75. So a full two percentage points higher than what they thought essentially 3 months ago. So with that, as of Friday, the swap market is now pricing in the RBA's cash rate to end up at 3% by the end of this year. So if you look at that they're pricing in 25 basis point moves by the end of the year. And, if you have a look, we've only got 7 meetings now before now and the end of the year. That will tell you, if you do the math there, we've got a series of 50 basis points or even higher potentially moves. So if the RBA in fact does follow through with that kind of trajectory, it would make it one of the fastest rate tightening cycles that we've seen since 1994. Now, in 1994, they moved rates 3 times. And in total, they did that over 5 months, moving at 2.75% higher. So what's interesting about what happened around that tightening cycle in 1994 was that inflation actually peaked out 12 months later after their last rate hike. So it'll be interesting to see whether the RBA actually takes that same playbook and applies that this time around, if they see factors as being temporary and they maybe take their foot off the accelerator in terms of raising interest rates. But yes, so far, look, the market is pricing a fairly aggressive increase in short rates. So this morning, I really wanted to talk around rising interest rates and the effect that has on market performance. So having a look here, firstly, let's have a look at resources. Given the previous rate cycle did occur in the middle of a resources boom. If you remember, China entered the WTO in December 2001. And subsequently, we went through a fairly strong resources super cycle. So while it's clearly a mixed picture, generally the markets are a little bit volatile in the first 3 months, but it recovers very, very soon after. It does generally show that markets bounce back or are even not affected by rising interest rates. So you might be thinking, okay, that's resources. We're in the middle of a resources boom. Well, having a look at industrials, in fact, bar 2007, you could be argued that the performance of industrials perhaps even held up a little bit better than resources, suggesting perhaps that an inflationary cycle or reflation cycle or even an interest rate cycle is a good thing for industrial names. So look, while it's inconclusive, it doesn't show you a clear linkage between sort of negative market performance and rising interest rates. I think one thing it does categorically rule out is that, automatically it's a bad thing. I guess the market's view is that, rising interest rates is going to be bad for the equity market, and that the data there tells you it's not so. In fact, while we do see some volatility in the short term, once the market gets comfortable with rising interest rates, generally it recovers and recovers quite strong. So onto our cycle, where we're at the moment, I guess what we think is the big driver of the market, some of the key indicators that we're looking at. While we're not suggesting for a moment that rising interest rates won't impact economic growth, it clearly will. I guess it's going to affect the cost of living. There are a number of market indicators that we look at which suggest that the equity market will be very much supported over the next little period. So first on the top left, EPS revisions are still broadly positive right across all sectors of the ASX. This is despite the fact, we have got rising oil prices. We've got the war in the Ukraine lingering on, tightness in supply chain. But what it tells us over the last 3 months, we're seeing EPS revisions pretty much across the board. Yes, there's some weakness in certain sectors, namely consumer services, but generally speaking, it's quite positive. And when we are seeing, some of those perhaps conservative EPS revisions being reflected now with the Aussie Aussie economy actually holding up quite well. Secondly, valuations ex resources, and we've said before that you've got to look at the Aussie equity market in disparate groups, because looking at the overall market multiple doesn't give you a fair reflection of really what's happening with valuations. But if you look at pure industrials, they have come back a long way. They've peeled back to essentially pre-pandemic level. Yes, it's still above its long-run average, but it's suggesting there is some value perhaps creeping back into the market. On the bottom left-hand side is Citi's Economic Surprise Index. Now, we like to look at this one because it tells you or gives you an idea whether or not the incoming economic data is surprising on the upside or surprising negatively. And what you can see there, clearly we are in still a very strong period for the Aussie economy. We know that the household savings rate is high. We saw retail sales last week actually beat consensus quite strongly. And as some of the commentary in Alex Mee's note last week, he mentioned there's heightened consumer demand, and retail conditions continue to be very strong. And even with the impact of the floods, rising cost of living, consumers are still going out and spending. So really holding up that demand profile. And then the bottom right-hand side is more a sentiment indicator, but it gives you the average discount to consensus price targets. And it shows you here that the median discount, the price target across the board for ASX industrials is about 15% versus its long-run average of 5%. So, it generally shows you that there is, some value in the market when the discount blows out this wide. So we are positive, the cyclical parts of the market. I guess where we are perhaps a little bit concerned is some of the high PE names. We like to show you this chart of dispersion between the high PE and the value segments of the market. What we've tried to do here is break that into market interest rate regimes to give you a sense of, what's happened over the cycle. And you can see clearly, low interest rates or even, interest rates near zero have really fueled that expansion between sort of growth and value in the Aussie market. So, while we have seen some of those high PE segments or those stocks actually peel back quite sharply, if the market is right and the RBA is going to move rates close to 3% by the end of this year, this will take us back to 2012, 2013 levels. So the spread there, the PE spread, generally between value and growth is between sort of 5 and 10 PE points. Now it's much wider now still. So look, even if, the interest rate cycle doesn't end up at 3% at the end of this year, or even doesn't reach that peak of 3%, say it's 2%, 1.5%, it suggests potentially that there's still a little while to go before we sort of hit that fair value of fair spread between sort of low PE and high PE stocks. So while I'm not suggesting we're going to go back there very quickly or even go back to 2012, 2013 levels because of some of the dynamics playing in the Aussie market, namely the high growth segment of the market is achieving a lot higher growth than what we were, even 10 years ago. It represents a much broader cohort. ASX IT segment of the market makes up a lot bigger. Back then it was 1%. Now it's closer to, I think, around 6%. And the quality of some of the growth names in the ASX are a lot better than before. So it certainly warrants a premium, but it's just how far that premium is, and suggests that maybe in the short term we will continue to see a little bit more consolidation there. I've highlighted a few of the names where we could see a bit of weakness. I do note that some are in our best ideas list, and we do like them as high quality growth names, but it's just a matter of whether or not, we're at that sort of, the relative value range for some of these names. So suspect we may see a bit more consolidation in sort of that high PE segment, but nonetheless, the underlying economy will continue to really support the equity markets.